Hello everyone, I'm delighted to introduce to you our next workshop, Asset Allocation and Trading in a Lower Interest Environment. Before we start, a quick reminder, online trading involves the risk of losing your funds. Make sure you understand all of the risks involved, exercise caution, and trade with brokers you trust that hold the appropriate license by the FSCA. And now please welcome on stage Roger Eskinazi, Managing Partner at Tickmill, South Africa. Thank you.
1, 2. Thank you, everybody, and thanks, Jeff. Good afternoon, everybody. Welcome to the session. I'll try and make this as interesting and as interactive as possible, rather than stand here and tell you all something that you may already know or not know. So the topic of today's discussion is investing in a lower interest rate environment. You might ask the obvious question, well, are we in a lower interest rate environment, both globally and locally? And the answer is no. But the best way to illustrate this is when one of the world's greatest ice hockey players ever, Wayne Gretzky, he was asked the question, why is he so good and why is he leagues ahead of any other ice hockey player in the world? And his answer was, because I skate to where the puck is going to be, not where the puck is. And you can say the same for any soccer player. If you know where the ball is going to go in soccer and you can get there first, you'll undoubtedly outperform the opposition. So the whole premise of asset allocation is positioning your portfolios appropriately before events change. And that is why it's so important to get asset allocation correct for a long-term portfolio. We've known over the years, and there's decades of statistic experience, that the biggest driver of performance is asset allocation. So making sure you're in the right asset classes at the right point in time. So let's take a look as to how we can identify it. So this investment clock appeared for the first time in 1937 in the Royal Evening Standard, and then it was repurposed during the early 1980s by Merrill Lynch. And it became very popular because of its way of depicting asset classes in relation to the economy. And how does it work? Typically, it's a clock face, and each of the phases, 4 different phases in an economic cycle: recovery, overheat, stagflation, reflation. Each of the different stages of the clock, you'll see that on the top, the horizontal axis, you've got inflation. And on the bottom axis, you've got, on the vertical axis, you've got growth. So typically, if we move through the cycles now, and we say, would anyone, let's talk about the US for a moment. Can anybody perhaps tell me where we are on the clock in the United States? All right, so yes. Yes, that's true. So where we are in the United States is that, I'm not going to go back and give you all the history, but obviously we've had, since 2008, when we had the global financial crisis, we've had pretty much one-way traffic and a very, very strong equity market for the last 10 years up until and including 2020. And why is that? And that was because interest rates in the United States were at 0. Now, can you imagine that if we had 0 interest rates here? I mean, can you imagine how full places like Lewis and Foschini and Bradlow's, how that would all be? And that was the case in the United States. In fact, it was such an anomaly for the last 10 years that you had to pay Deutsche Bank to hold your money. They didn't pay you. So it was an unbelievable period in financial markets where the United States printed in excess of $34 trillion. $34 trillion in stimulus packages and what they called quantitative easing. That just pushed interest rates to 0, and sometimes it pushed it even to negative. So this had never happened. This was unprecedented in history. What happened when you have interest rates at 0 for so long? is that the economy starts to overheat, too much money chasing too few goods, inflation starts to rise. Inflation has risen over the last 2 years in the United States, and I think at its headline it was just above 9%. We're now back to about just over 3.5%. So the economy overheats. Now, what is the tool that the Reserve Bank uses to control inflation? Interest rates. Correct, interest rates. So when the economy gets too hot, too soon, too much money chasing, they start to hike or increase rates to try and curb spending. And that's where we've been now for the last 18 months. The US has raised rates, I think, 11 times in the period between July 2022 and March 2023. 11 times they've increased rates in increments of either 0.25% or 0.5%. So it then pushed the economy to overheat, and now we're starting to see a reversal of that. So inflation has now started to come down. At the last print, as I said, it was about 3.5%. And we are now in a position where everybody's waiting for interest rates to come down. I think the consensus in the United States and pretty much here in South Africa is that we're at the top of the interest rate cycle, and the next move, barring we have any exogenous shocks like a rise in oil or a geopolitical event, the next move will be down. So what you want to do is you want to position your long-term portfolio in the assets that are going to benefit most when interest rates happen. You can't do it on the day. Markets don't work like that. They're impossible to time. So you need to have the right amount of money in each of the buckets that would outperform. So typically, and I've managed money through countless crises, 1987, 1989, 1990, 2001, 2011, 2012, 2015, 16 when we had the fallout, 2019, 20 when we had COVID. And it is amazing how accurate this investment clock is around positioning of the assets. So what are the assets best placed in this environment for interest rates coming down? The first one that outperforms tend in this market here is REITs, or what we call real estate investment trusts. Does anyone know what that is? You know what that is? Okay, so a real estate investment trust is a unitized, regulated portfolio that invests in a basket of properties. And they can either be commercial, residential, or industrial. And there's some very big names across the world that specialize in this. Storage is another very popular one, and that's become a very, very popular investment across the world. Now, this has been an absolute nightmare. The last 2 years have been a nightmare for real estate investment trusts. Why do you think that is? Why has it not been a good investment? Yes, sir. Correct. Interest rates are way too high. Now, what happens when rates are too high? The values of the property then goes down because you're using a discounted cash flow model, and then your delinquencies go up because people can't afford to pay the rent. And then throw in a pandemic in the middle of all of this, and people lost a lot of money on real estate investment trusts. What we're now starting to see is a normalization to this asset class where people are smart asset allocators, hedge funds, sovereign wealth funds, and individuals are now starting to allocate healthy chunks of their portfolio to real estate investment trust. Now remember, a real estate investment trust, it has to by law distribute 90% of its profits as a dividend to its investors. So if you're sitting on any spare cash, real estate investment trusts, if we look over history, the last 70 years of history, it has been the best outperforming asset class over 70 years. More so than equities, more so than commodities, but it doesn't go up in a straight line. It's very volatile, but like anything, it rewards the patient investor very handsomely. The next asset class that looks very attractive now are bonds. Does anyone know what bonds are? Okay, so bonds are basically debt instruments that are issued by the government or a corporate. They promise, you invest money with the government. Let's look at South African example. So, for example, the South African 10-year bond. You put R1,000,000 in the bond. You're loaning the government R1,000,000. The government promises to pay you back that R1,000,000 in 10 years' time. And every 6 months will pay you a coupon, or every year will pay you a coupon of 10.86%. Now that's a very attractive rate of return. You're getting 5% every 6 months as the coupon, plus the promise of your money back, if the South African government stays solvent. And that's another debate for another day. So that's a very healthy return. But the interesting things about bonds, a lot of people don't understand, is they have an inverse relationship with interest rates. So when interest rates go up, what happens to the price of your bond? It goes down. In 2022, when we had the 9 consecutive interest rate hikes, that was the worst year in modern history since 1918 for bonds as an asset class. People got wiped out. Your traditional 60 equity, 40 bond portfolio got massacred because it's the first time that they both went down together in lockstep. So bonds are normally either a good diversifier to hold with equity because they pay a coupon and it's non-correlated to equity, or as an asset class, they can offer you a very good return in terms of the coupon plus the upside. So if we start to see inflation start to cool down and interest rates start to be cut, bonds as an asset class will do exceptionally well because you're still getting your coupon. In the US, it's about 5.5% on the government bonds. In South Africa, it's about 10%. And our base case for South African bonds, provided rates don't go up, and we don't think they'll go up from here, is you could make upside of about 18 to 20% from a decent bond portfolio of government bonds, which is very attractive. As we now start to move into the environment where interest rates, provided it's still disinflationary and inflation hasn't gone out of control, the economy starts to recover, and this is historically the best time to invest in stocks. Now, all of you guys are equity guys. I'm sure you're all interested in stocks. What have stocks done? Well, surprisingly, stocks have done remarkably well in this, and I'm talking in the US, in the face of rising interest rates, and that's a bit of an anomaly. And the only anomaly that, can you tell me what the biggest reason was for the US equity market rising? Sorry? Correct. 100%. The Magnificent 7 stocks. Now, these stocks are NVIDIA, Google, Alphabet, Meta, Tesla. I can't recall all of them. They account for 36% of the GDP, of the market capitalization of the S&P. It's massive. I mean, if you held NVIDIA is up 386% in 2 years. Tesla's not far behind. It's come down a lot. Google, Alphabet, all in a multiples of 150, 200% in 2 years. Now, that's one hell of a return. So the rally in the US stocks has been very, very narrow, driven by 7 main stocks. Do we think this will continue? I think the valuations are very lofty, so that means there's an expectation that they will continue to grow earnings in excess of what the analysts. The problem was, if any of these companies miss earnings, they can get wiped out 15, 20%, 25% on the day. But with the way the world's moving, I mean, you look at Facebook, they control 4 billion people. Apple's got 2.5 billion users. This is the way of the world, and it'll take a brave man to bet against a revaluation of AI stocks. So we don't think they're going to go down. We don't think they're going to go up in the same proportions, but I would still hold a large proportion, or decent sized proportion, to the AI stocks, knowing the risks that come attached with it. So what are you holding now? How are you building your portfolios in terms of this anticipated drop in interest rates? You're going to be holding a decent chunk in bonds, where you're going to get a monthly coupon, and you're going to get the capital upside when rates come down. That'll be as a hedge. You're going to start building a stock portfolio for when rates come down, because historically, that is when stocks that's their Goldilocks moment. That's the sweet stock for them to start performing. Another interesting thing is because of the narrowness of the performance, because most of the performance has come from 7 stocks, there are certain sectors that are looking very interesting. In the US, it's the Russell 2000, which is the next layer of stocks which have smaller market capitalizations. And these often catch up later in the cycle. But it's certainly worthwhile now to hold small cap stocks or medium sized stocks as interest rates starts to fall. These stocks, they like the gearing effect of that. So now I've got my bonds, I've got my stocks. Commodities, that's an interesting one because commodities have a very tight link with inflation or inflation surprises. So anytime the market sniffs that inflation is going to be a problem or there might be an inflation surprise, commodities will tend to do well. And we saw this, how some of the commodities have rallied recently as rates have gone up. We still think that a couple of factors are going to weigh heavily with the commodity cycle, although it's one must be very careful in how one plays this. Do you actually go and buy the spot commodity prices, or do you go and buy the actual commodity miners? And there's 2 ways of doing it. We like to play the gap where the miners, the actual share miners, haven't delivered performance, and there's the discount gap between the commodity spot price and the actual share price of the company. So commodities, we like the story for commodities for the next 2 to 3 years. We think that China will now come out of its slowdown slowly. It's already starting expansionary stimulus programs. So we like commodities as well. And we're holding a bit of gold. Gold has been an interesting one because, once again, this has been the perfect environment for gold because people have hedged against political risk. People want it as a store of value. People started holding gold when interest rates were 0 because it's a lot easier to hold gold when interest rates are 0. If you have the opportunity of holding a US Treasury yielding 5%, that's an opportunity cost you need to forego. But the interesting thing why gold has rallied so much is because for the last 3 decades, since the invention of the Bretton Woods system, central banks have been selling gold discriminately, buying the US dollar. That has changed, and you're starting to see now that a lot of governments, specifically emerging markets, are now buying gold like we've never seen before in terms of propping up their reserves. And remember, in terms of the IMF, only allows gold and currencies as official country reserves. You can't buy anything else. You can't buy Bitcoin or crypto or any of that. So you'll have gold, which will give you the upside if the world, as a hedge, if the world goes bad, but also will start to give you a nice diversifier to your stocks and your equities portfolios. We don't think we're heading towards stagflation. Stagflation means low growth or no growth and high inflation. Now that's a problem. That's a problem for everything except cash. If you're having high inflation and you're having no growth, your stocks are going to go nowhere, your bonds are going to go nowhere. The best thing you're going to be doing while interest rates are rising and the reserve banks are trying to prop up inflation is to buy cash reserves, or inflation-linked bonds, or what we call them in the US TIPS, Treasury Inflated Protected Securities, that will give you a return linked to inflation. So if inflation surprises on the upside, you're then getting a return that is equal to that. So I think that gives you a fair idea of where we are in the cycle now and what to hold. What would be the optimal asset allocation now? I think for a balanced investor who has a 5-year outlook, I would probably have a stock portfolio of around 55 to 65% in equities, of which a large cap would be emerging markets and China, which is looking very attractive. I would hold 30-odd% in high-grade government bonds, maybe a smaller amount in high-yield bonds, where you can get a higher yield for a little bit of a higher risk. And I would hold about 5 to 8% in gold and the rest in cash. Any questions? Yes, sir.
Thank you so much for all the information, and good afternoon to everyone. I just wanted to ask, as a person who's beginning to buy stocks, would you suggest looking into ETFs or individual stocks, depending on your target as well? because I know with ETFs, like you can have like lots of stocks in terms of companies, and it doesn't really like matter on like what's this, your like what company performs what, because either or, like there will be another company doing better than the other one. Would you suggest starting off as ETFs and then maybe later on in stocks, but looking at emerging like companies?
It's a very good question. So there are two ways to buy stocks. One is you go and buy and choose your own. There's three ways of doing it. One is you go and buy your own stocks. You go on the JSE and you buy Anglo, Sasol, Billiton, Woolies, ShopRite, etc. It's not very tax efficient because every time you buy a share and you sell it and there's a capital gain, you need to start making tax payments on that. So a lot of people have moved away from holding individual shares to holding what we call a unit trust or a UCITS, where the gains are rolled up within the fund and you only pay capital gains when you sell units. The other way is buying an exchange-traded fund. It's much cheaper. It gives you a lot of diversity. Exchange-traded funds have a place, and as a core, if you want to get, say, exposure to the US, I would most undoubtedly buy the S&P 500, or if I want to get exposure to China, I'd go and buy the Hang Seng, and then I would then look to enhance that position with smaller outperforming managers who have outperformed the index. So you want a combination of both exchange-traded funds and active managers. Now, very few active managers actually outperform the market. We know that. But there's some very, very good active managers that are a nice complement. But I would say as a start, I would go 70 to 80% exchange-traded funds and 20% odd into managers that are specialists in the region. Yes, sir.
Thank you so much, Mr. Eskinazi, for that information. You speak a lot about commodities and all these assets as long-term investments. As you know, there's a lot of traders on the floor. So, in terms of a more shorter time frame, how are they able to be of benefit to traders? As I view them as more long-term yielding assets. So in the short term, how can it be of benefit?
Yeah, I always say to my good friend Hormos here that as a long-term manager, I sell sleep to clients, and as a trader, he sells nightmares. So it's a very different thing. So I think, like with anything else, in terms of trading, one has to understand where the opportunity is and what the price differentials are in terms of whether you're trading gold or whether you're trading. The same fundamentals still apply. So how would it work for a trader? Well, now would be a good time to go long bonds. You can go long bond index, and you can short you can probably short one of the. You could probably short the tech index if you think tech's run too far. Commodities, you could probably go long gold, and probably long. I would definitely go long copper. I think copper's got an amazing trajectory ahead as the world transitions to a net zero economy. We've already seen a magnificent rise. So once again, whether you're a long-term investor or a short-term trader, one's got to say, what assets do you think will outperform at a particular cycle? So it's about identifying the assets. Then you can decide to go whether to go long or short. The problem with trading is that it's such a spontaneous thing that a lot of these asset classes need time to play out. It doesn't often happen like clockwork immediately. But I can tell you now, they say history doesn't repeat itself, but it often rhymes. And this is often proven to be a very, very accurate guide of what to hold in what asset classes.
Good afternoon to everyone. My question is on China. What are the reasons why you think China is likely to perform well?
Man, China, I tell you, we could open a bottle of wine on this, because I recently came back from Beijing and Shanghai, and it's amazing to see what these people have done, and it's amazing to see how much of the information is inaccurate. I mean, these guys are not going anywhere. If you look at China, and there's been a slowdown. For years, they've been growing at 7, 8, 9%, when the rest of the world was limping along at 3 or 4. Obviously, there was a bubble in the making there, and the bubble has transpired. in terms of its property exposure. We saw Evergrande, which is the big property developer that they liquidated $300 billion worth of assets, and that started a chain reaction of some of the other properties. So they have a problem around excess, building cities, building infrastructure for people that was not utilized. But if you look at it on a pure, so the answer to your question is, on a pure valuation basis, China is the cheapest it's been since 1929, since the Great Depression. And it's the cheapest it's been against the US in 50 years. Now, let me tell you, man, you're going to have to be a very, very brave guy to ignore that. Because the only thing that matters when you buy stocks is your entry price, right? The price you get in. That determines everything. And that's determined by your PE ratio or how you ever want to determine how much expensive. So if you look at some of the, if you go and buy China now, and you put that in the bottom drawer, you buy the index, there's a couple of 50, 100 baggers there in terms of returns. So we're very excited about China. The best time to buy it, as Warren Buffett said, is when there's blood on the streets. And for months, people are saying, oh, China's now uninvestable and there's too much regulation there. We don't know. We don't trust the socialist government. We don't trust the People's Community Bank of China, etc., etc. But it will take a very brave man to bet against China because the US is incredibly expensive on a forward metric. China is incredibly cheap. The other one that's incredibly cheap is South Africa. The joker in the pack is what happens next week and in the lead up after the elections. Remember 5 years ago we had what we call Ramaphoria, where we were all so excited that Cyril Ramaphosa was being elected as opposed to Nkosazana Zuma, the health minister. So the markets rallied and it was an excellent time for South African stocks. And that slowly unwound as the promises that he made to the country have not transpired. So we're very bullish for the first time. As allocators of capital, we are, for the first time, neutral, which means at weight for South Africa, where we've been negative for 10 years. We haven't allocated to South Africa for 10 years. And I think a lot of overseas investors, because of the valuations, I mean, you can go and buy South African banks. I think you can buy ABSA on a 9% dividend yield at a 6 times PE. Where are you going to get that in the rest of the world? It's unheard of. It's unheard of. And you can make a lot of money if you hold these banks, if you hold some commodities, if you hold some of the cyclical consumer defensives. There's a good story here. Unfortunately, it's very sentiment-driven, and it needs some good news. And I don't know if we're going to get that. We're hoping for a good election, a result. But if you're a brave man, I would put some money into the market now.
Question, Roger. Thanks for the presentation. Regarding gold, you mentioned 8% of the portfolio, up to 8%. How would you buy gold? Like, is it also an ETF? ETF is the way in, or is there any other ways? What are the ways to buy gold in your opinion?
Yes, good question, Hormos. So the ETF that we would recommend is SPDR, which is a gold ETF that is broad-based, and you're actually buying the underlying price of the gold at any point. It's a very easy, cheap way to access it. Another way, as I said to you, is identify 1 or 2 miners that have not only gold but other diversified metals exposure, where the performance of the share price has lagged the underlying commodity. And I think as rates start to come down, these miners would start performing. The miners don't like a high interest rate environment because they're generally highly geared and it costs them more to get the metal out the ground. As rates start coming down, you often see an increase in production, an increase in productivity, an increase in earnings, an increase in profit growth. And with commodities, I mean, if you bought Implats or Amplats 18 months ago, you're up 150%. But the commodity cycle is notoriously tricky to call. Otherwise, we'd all be sitting drinking mojitos in Mexico. But yeah, I would buy the gold ETF. I think gold has got a lot for it going on. I generally don't like gold because it costs to hold it. You're not earning anything. And for a long period of time, you can underperform. But I think now with a lot of people diversifying away from the US dollar because they think the US dollar is going to weaken, central banks are buying aggressively. It's massive underpin for gold as an addition. Any other questions? Yes, sir.
You mentioned about banks. Like, what are your thoughts on Take Your Money Everywhere Bank, since it's not listed on any platform worldwide, but there is plans of it getting listed, like your Time Bank, like by Mutsipe. Like, it's been getting a lot of funding, and it's the first bank that's banking on an air cloud, which is totally different from like the rest of the banks that we have in South Africa. So what are your thoughts on that, like in terms of looking into investing in such a bank that's never been listed on any platform?
I think the problem there is, how do you get your return? Unless it goes the same route as Capitec and becomes the next darling and, manages. I think I was reading yesterday that Capitec has got now more clients than Discovery, Absa and Standard Bank put together. I mean, that's been an amazing story, and they've gone from micro lender to full suite of bank products. So generally for us, listed is the way to go because there's transparency, there's rules. The only way you can access some of these smaller banks is through a private equity listing, or you can get through an OTC offering, but then you don't have the backing of the security exchange. But I think, like anything, you build your core, your 80% risk-free, your 80% portfolio that's going to protect you. Think of it this way. Think if you're going to build your main portfolio as you go from 25, 30 years old to 60, you want to build a tanker that's going to not withstand any financial storm, any crisis, holding good, strong quality, well-priced assets. And for 20%, you can have I don't like the word play portfolio because it's too stressful to play. You can have your trading portfolio, sir. You can buy, you can sell, it keeps you interested and, it keeps you in the market. But for the main, build your core portfolio for the long term. Time is your friend and impulse is your enemy. There's a very interesting sum which shows you the value of consistency and how compounding makes a difference. So if you take 1 to the power of 365, gives you 1. If you take 1,01, just 1%, 1 basis point, 1,01 to the power of 365, gives you 37.7. And that, the power of compounding over time, we've known that the biggest enemy in investing is yourself. Letting emotions get you. Guys must know it from trading. Understanding your biases. Do you have loss aversion bias? Do you have survivorship bias? Do you have the mental makeup to go against the market on a trade that you believe? The human mind is a very, very powerful thing, and it often is not a good place for investors to be. One's got to be emotionally detached and make sure that the business case or the case which you bought or sold the asset in the first place is still prevalent. Yes, sir.
I just wanted to find out why you haven't mentioned anything about European markets.
Have you been to London lately? It's a basket case. You actually come back and think, geez, I'm glad to be in South Africa. So I think it's just generally, there's a lot of malaise in European stocks. There's a lot of anticipation that things will go up in time. For us as a region, in terms of valuations, it's just not as attractive to us as some of the emerging markets, Europe. And yes, in any market, there's going to be pockets where you're going to find very underpriced, very well-established, well-capitalized companies. But as a holding in an equity portfolio, I think it's probably too early for Europe. I would rather allocate to China, other emerging markets, Brazil. India's a bit expensive, but India's still got legs. especially if the dollar starts to weaken. The dollar has been so strong. It just can't continue on strength like this. And what we've seen is an obvious correlation. Dollar weakens, emerging market currencies strengthen, emerging markets, stock markets go up. So if we said we're going to hold 60% odd in stocks, I would probably hold 40% US, which is tech, and next level Russell Index 2000, which is your ETF. I would then hold 20%, 10 to 15% in China. The other spread amongst India, South Africa, South Korea, Taiwan, and Brazil. Yes, sir.
I want to know about your perspective about cryptocurrencies. Crypto.
Yeah, you're asking the wrong guy here. I'm from a different generation. What I can tell you is that digital blockchain is here to stay. Is it a good investment? For us, it's too speculative now to invest in a long term. I would put that in the, remember I said the 20% play portfolio? I would then go and buy Bitcoin or buy, in fact, in one of our portfolios called Chaos, which is our aggressive portfolio, we bought an ETF, a blockchain ETF, which invests in the underlying technology. The name of that ETF is Block, B-L-O-K. That thing went up 94% in a month and a half. So we bought it and we sold it. And for us, that is a far more attractive way to play the crypto space than to actually go and buy, well, will Dogecoin beat Ethereum? Will it beat Bitcoin? It's just anybody's guess. And there's just too much speculation at the moment. But have it in your play portfolio. But in terms of your core portfolio, take a look at that ETF, Block, B-L-O-K, because it actually makes money. It's a digital ledger. There's revenue attached to it. It's listed. A lot of protection. Bitcoin, you're on your own, as you know. And if you were lucky, I mean, a lot of people made a lot of money, and they deserve to because they had the courage to do so. So good on them. They deserve it. Anybody else? Everybody happy? Thank you for your time and all your questions. I appreciate it. Thank you.